With so many option strategies in existence, which strategies would be best or suitable for a beginner options trader? In this video, we're going to be walking through what I believe to be great starter option strategies if you are new to options trading. So let's not waste any time and get started. The first strategy on today's list is the covered call, because covered calls allow stock investors the ability to create an additional income stream from selling call options against shares of stock that they already own. And you have to own at least 100 shares to implement this strategy. Trading a covered call position is less risky in all cases than owning 100 shares of stock, because we're going to be selling options while owning the shares of stock, and the amount of money that we collect from selling the options is going to provide us some downside protection. How to set up the trade is to first buy or own 100 shares of stock. So if you already own 100 shares of stock, you're ready to trade a covered call. All you have to do is do the second part of the trade, which is to short a call option against the shares. So this is how this would look. This is an example covered call setup in Amazon. Let's say we buy 100 shares of Amazon at $85.82, meaning we pay $8,582 for these 100 shares. Then we go into the March 2023 options, which as of this data was 73 days until expiration. And we went to the 100 call and we shorted the 100 call for $2.56, collecting $256 into our account from shorting that 100 call. In this graph, we are looking at Amazon stock versus the covered call position. So we can see the stock price, what it's doing in relation to the call option that we sold at the 100 strike price. And then on the bottom, we can see the stock P&L, which is just the 100 shares of stock, and then the covered call P&L, which combines the stock P&L plus the short call P&L. So the covered call allows an investor to continue making money on their stock investment up to a certain point, which is going to be the strike price of the call that we sell. So in this case, since we're selling or shorting the 100 call, we're essentially limiting our upside on Amazon stock at any point above $100 per share. In this trade, the stock price surges well above the short call strike price of 100, and the stock position itself makes more money than the covered call position. So we can see on the bottom graph that the stock P&L gets all the way above $2,500, while at that point in time, the covered call P&L was only at $1,500. So we did have less profitability on their covered call compared to just owning the shares of stock. And that's because the stock price went way above the call strike that we sold. And when we have a covered call position, we do have limited profitability up to that short call strike price. But at the end of the trade, we can see that the stock price did actually end below the call strike, and the call option expired worthless. So if a call option is out of the money at expiration, meaning the stock price is below its strike price, then that call option expires with a value of 0. And since we shorted it for $256 initially, and the call option went to 0, that means we make a $256 profit on the short call position. So we made all of the gains that we could make on the stock while also making the max profit on the short call position. The downside of a covered call is when you have a huge run up in a stock. In this trade, we see that we have a initial stock price around $140, and we are shorting the 170 strike call in Nvidia at the beginning of 2023. In this trade, Nvidia rallies hard through the first 3 months of 2023, and we can see that the stock price ended way above the short call strike price of $170. And if we look at the bottom of the graph, we can see that the stock position itself made profits upwards of $11,000, but the covered calls P&L capped out around $3,000. The second strategy on today's list is selling put spreads, or the put credit spreads. Selling put spreads allows traders to make money when the stock price goes up, remains flat, or even decreases slightly over the trade duration, and this position has limited loss potential. Since there are many ways that the stock price can go while this strategy can still make money, the probability of profit is high. And this means the probability of profit is over 50% for this strategy, but will vary depending on how you set the strategy up. How we set up this trade is we short a put option, meaning we are selling a put option we don't own and therefore betting against its price. And then we are going to buy a put option at a lower strike price and the same expiration cycle. And that put that we buy effectively limits our loss potential on the put option that we are betting against. So here's how this would look. If we were looking at an option chain and we saw a 375 put and a 350 put, we could set up a put credit spread by shorting the 375 put for $11.95. and then buying the 350 put for $5.07. This would result in a total amount of money of $688 coming into our account. Since the 350 put was priced at $5.07, if we buy it, that means we're paying $507 for that put. When we take the net amount of money coming in versus the money going out, we get a total premium collected of $688 on this particular trade. In this graph, we are looking at this position versus the change in SPY over time. So this is a SPY put credit spread, and the short strike is 375, meaning we're shorting the 375 put, and we're buying the 350 put. A put credit spread makes money as long as the stock price remains above the put spread strike prices over time, specifically this higher strike price of 375. Depending on the specific strike prices you use, this means the stock price can decrease slightly and the trade can still make money. Here we can see that SPY starts at 380 and over the entire trade duration remains above our short put strike price of 375. On the bottom half of this graph, we see the profit and losses of this position over time. At trade entry, we have a starting profit and loss of 0. Of course, that's going to be the case with any option strategy. But over time, SPY remains above this put strike price of 375, and our profits on the position grow from 0 up to $688 at expiration. This is because at expiration, both of these put options are out of the money, meaning that they have a final value of 0, and that means our put spread has a final value of 0. And since we shorted it for a total value of $688 and its value fell to $0, that effectively means we sold it for $688 and bought it back for $0, making a profit of $688. So when you short something, you want its price to go down. The maximum profit you can make is the difference between your short entry price and 0. So why selling put spreads, I believe, is a great beginner strategy is that it has a high probability of making money, and that means it can profit when the stock price goes up, remains flat, or even decreases slightly over the trade's duration. Second, the strategy has limited risk, which means you know exactly what your risk is when you go into the position, and there are ways that you can set this trade up to make it more or less risky and risk a very small amount of money, which is important if you're trading a small trading account. So it is viable in small accounts because selling narrower spreads, for instance, selling a 100 put and buying a 97 put, results in a very low maximum loss potential and margin requirement. If you're watching this video and you're looking for the ultimate resource for learning options trading, please check out my free Options Trading for Beginners PDF, which at this point is over 170 pages and features my best explanations and visualizations to teach you the essential options trading concepts and strategies, plus a library of the popular option strategies featuring how to set them up, the max profit, the max loss, the break-evens, and example trades for profitable and unprofitable trades for all of these strategies. The link to download the PDF is in the description below. The third strategy on today's list is buying call spreads, aka the bull call spread. Buying call spreads allows traders to make money when the stock price increases, but with less risk and money requirement compared to buying calls all by themselves. The probability of profit will vary depending on how you set up the strike prices, which I'll talk about in an upcoming video. And the risk is limited, which is very important. How we set up this trade is we buy a call option, but instead of just holding that call option by itself, we actually short a call at a higher strike in the same expiration to reduce our loss and entry cost of the trade. Here's a visual representation of how we would set this up. For example, we could buy a call option with a strike price of 100 for $9.18, and then we could short a call option with a strike price of 110 and collect $4.75 for that, giving us a total amount of money going out of our accounts of $443. If we look at only buying the 100 call, we would pay $918, and that means that our maximum loss potential for just buying the 100 call would be $918. But by shorting the 110 call, we actually receive some money into our account, which offsets the cost of buying this call. And therefore, our net amount paid in position risk falls to $433 from $918. So the reason I like call spreads or buying call spreads as a beginner strategy is that it is much less costly and risky compared to buying a call option all by itself. In this chart, we're looking at Amazon versus the bull call spreads position. So a bull call spread, meaning we're buying a call spread, makes money when the stock price rises over time. The max profit occurs when the stock price is above the short call's strike price at expiration. That's the upper strike price of this position. In this example, early stock price declines led to losses on the position as the call spread lost value. Fortunately, the stock price reversed and rallied above the call spread by expiration, resulting in a $500 or more profit and a maximally profitable trade. I believe buying call spreads is a great beginner strategy because it is a cheaper alternative to buying calls, and this means we have lower money requirements and a lower loss potential. And also we have a better break-even price, which I didn't really talk about, but that means we don't need the stock price to increase as much as compared to just buying call options. So buying calls can be expensive, and by shorting a higher strike call against it, we create a spread and the total trade cost and risk decreases. Customizable risk reward is another benefit of the strategy because by using different strike price setups, traders can customize their risk to reward ratio based on the conviction of their stock price predictions. So if you're really bullish on a stock, you can set up a call spread in a way where you have more profit potential than loss potential. And if you're less bullish on a stock, but still bullish nonetheless, there's a way that you can set it up so that it has a higher probability of making money, but at the cost of less reward relative to the risk you're taking. The fourth strategy on today's list is selling iron condors, aka the short iron condor. Selling iron condors allows traders to make money when the stock price remains in a specific range over time. The short iron condor combines the put credit spread strategy, which is the strategy we just talked about, but adds a call credit spread. The probability of profit is high and will vary depending on how you set up the trade, but in general, a iron condor is set up with a high probability of profit. How we set up this trade is we're going to enter a put credit spread, which means we're going to sell a put spread. Then we're going to enter a call spread, which means sell a call spread. So here is a visual representation of how this works. Let's say we have 4 different strike prices. 2 of them are calls, 2 of them are puts. Let's say we think the stock price is going to stay in between 375 and 400 through this trade's duration. We could short the 400 call for $7.30 and then buy the 425 call for $1.65. Then we could short the 375 put for $11.95 and we can buy the 350 put for $5.07. If we add up the amount of money we collect for shorting the 375 put and 400 call, and we subtract the money that we pay for buying the 425 call and 350 put, we get a net $1,253 in premium collected into our accounts. So we pay $165 for the 425 call. We receive $730 for the 400 call. We receive $1,195 for shorting the 375 put. We pay $507 for buying the 350 put, which leaves our net amount received at $1,253. In this chart, we're looking at the SPY price change versus the iron condor's position P&L over time. So a short iron condor makes money when the stock price remains between the short strike prices over time. That means ideally, the stock price would remain in between 375 and 400 over this trade's duration. However, in this trade, the trade experienced losses when the stock moves towards or through the long strikes. If the stock price makes a big movement to the upside or a big movement to the downside, the iron condor's position value is actually going to increase, and since we want it to decrease since we're shorting it, we will actually lose money from the increase in the iron condor's value. If the stock price moves back in between the short strike prices close to the expiration date, the position will profit. So if we have some early movement against us, all we need to happen is the stock price to go back in between our short strikes by the time of expiration for us to make money. Why I believe selling iron condors is a great beginner strategy is because it's a limited risk market neutral strategy. And this is important because many other market neutral option strategies have unlimited or significant loss potential, and selling iron condors is a safe introduction to market neutral trading. So it's a much better and much safer alternative than shorting straddles or shorting strangles, which is basically just shorting put options and call options with no protection in either direction. And what that means is if the stock moves up or down really big, then you're going to have huge losses on those positions. And they also require a significant amount of money to trade because of their high risk nature. The trading software used in this video was tastytrade, and I've been trading with them since 2016, and I highly recommend checking out their platform due to their pricing structure, which is very favorable for active options traders, especially if you ever trade more than 10 contracts due to their capped commission structure. I love tastytrade because of their simple platform with very helpful features such as right-clicking to set up an order to automatically close your position or to set up an order to close a position at a specific profit target. I also love the simple feature of viewing options and charts so I can see historical price patterns of specific option contracts before entering trades. Lastly is their attractive funding bonuses, which currently scale up the more money you deposit with them, but may change depending on your viewing date. So be sure to check the link in the description below to see current offers. If you appreciate my work, then using the link in the description below to sign up for a new account is a phenomenal way to say thank you. My name is Chris from Project Finance, and I will see you very soon in a new video.